This lesson is about determining the strength or weakness of the supply-demand area. I will be taking you through the process of scoring the zones in hope of qualifying them for your trade entries. The whole point of supply and demand is that very few supply-demand areas will actually be tradable. This means that the zones ideally have to satisfy a number of conditions before they are deemed acceptable for actual trading. I prefer to trade through confirmation entries done my way, so not waiting for like a huge move to happen and then go in. I have a better way of doing it by looking at developing price action. But before you can even start to do that, you need to learn how to score the zones so that you understand what potential issues might be if you're planning on trading them. To identify potential issues with your supply and demand zones, you need a number of conditions to be satisfied. And I've said before that supply and demand can technically work in both directions. Trying to trade supply and demand both ways is a pitfall of many new traders who kind of stumble across supply and demand on some forums and then read through all the forums on the weekend and then attempt to trade through supply demand come Monday. So if it was that easy, just, identify drop base rally and then place a trade, obviously everyone would hear about supply and demand and it would be amazing to trade even if you don't know anything about it. So obviously it's much trickier than it looks. So why would you score the zones at all? Now, when you first start with supply and demand, scoring the zones will put you on a path to recognizing potential problems around the zone, especially on the way to your potential target. But then also there's a condition that says that you need to look at how many times the zone has been touched. If you remember from the first lesson, I say that the zone is usually reactive upon a first pullback, maybe second pullback. By the time the area is touched for the third time and the fourth time, it's very unsafe to trade it. Like, it's possible, but you're expecting a break of the area. So obviously the more times the zone is touched, the less orders you have lying at the level, which in turn weakens the area. Now, in case I've not made this completely clear by now, supply-demand traders, we look for the pullback into older existing zones. We're not going to randomly guessing where the price is going to turn. There's always a price action event that we're basing our decisions on. Now, before I continue, I'm also going to say that the scoring table is an excellent educational tool, but further down in the Pro Development Program, there is another strategy that I explain as a way to position yourself based on supply and demand, but without the scoring. Because some weak zones on large time frames can be reactive, especially if they're located at a Q point area. But anyways, moving on. When it comes to supply and demand scoring, keep in mind that this process will exclude most of the zones. So you're not expecting to trade every single supply and demand zone that comes along, but only very few of them. To begin with, I will say that there are 6 conditions that need to be satisfied before you would even qualify the zones as tradable levels. There are 3 filters and 3 odds enhancers. Filters. If any of these 3 filters are not there, the level will not be suitable for limit orders. Now, it might still be tradable, but through confirmation entries the market stalker's way, which means looking at the developing price action at the level. But if you're only trading through supply and demand, for now let's stick to these rules. And of course I mentioned the odds enhancers as well. Now, odds enhancers, probability enhancers, they're obviously slightly different, meaning that if some of the odds enhancers are not there, the level might still be tradable, but you can decide whether you're going to execute it through a limit order or through developing price action, aka confirmation setups. So let's go through each of these conditions separately. We're going back to filters. Here are the 3 filters. you have the strength of the initial move away. If you remember the first lesson, I said that the larger the initial move away, the stronger the zone. So this is obviously a very, very important thing. The second filter is that you're looking for sufficient profit margin. When you're looking at a zone, obviously that zone will have a number of pips to it. So the zone can have like 60 pips, 70 pips, 35 pips. And the profit margin will be determined how many times away did the price move from it. So it could be twice the amount of initial zone size. So if you have a zone of 35 pips, then 2 to 1 profit margin means that it's 70 pips. Having a sufficiently large profit margin will ensure that if you do enter a trade, you can then have enough space between your trade entry and the intended target without running into any opposing supply-demand areas. And finally, the third filter is the presence of some kind of a base or consolidation. Now, obviously, this pertains more to the daily chart, 4-hour chart, 1-hour chart, because as you've seen in one of the previous lessons, if you have a very large time frame, they will likely have a 2-candle formation. So the normal formation rather than a proper base. So let's start with the strength of the initial move away. The bigger the move, the stronger the zone. This implies that there's a lot of interest at the level. So when the price comes back to retest the area, there should be some large institutional orders waiting around. So at that point, it's not actual inventory, but it's pending orders, for those who are wondering. Some people say that, oh, there's a lot of spoofing and stuff, but do remember that the level that was there originally, that caused the initial move away, that's when the institutions actually had inventory there, right? So those were real orders at one point, which caused the initial move away to happen. Now, along with this initial strong move away, the price also needs to stay away from the zone for an extended period of time. If they come back to it after just one move without any follow-through candles, meaning you don't have a second candle in the same direction, that means that the zone is really not that strong, especially if the price returns to the zone immediately after the initial move away. So in effect, it's a failed move away. Ideally, you're looking for, at the very least, 2 candles away from the consolidation. Moving on to the profit margin, how far away did the price move before coming back to it? Now, something to keep in mind is that the profit margin and your own reward risk ratio on your trade are not the same thing. The profit margin of the actual level could be 23 times the size of the level. Let's say, just for argument purposes, that you have a level that's 10 pips wide. So you're looking at a supply-demand zone that's comprised of 10 pips from the conterminus line to the borderline. If the price then moves away from that level 23 times, that means it's moved away 230 pips. But that is just the profit margin of the level, which is 23 times. It's not your own risk-reward ratio, which should really be at the maximum 4 to 5 times, but you should already think of booking your trades once your trade crosses over 2 times reward risk. So the point being is that if the profit margin of the level is massive, you're not supposed to hold your trade do or die until it reaches the 23 full max percent, because you don't need that. You just need your statistical edge. Now, back in the day, when I say back in the day, I mean about 7-8 years ago, the market conditions were a little bit different. So you had a lot more momentum. So you could get in on a trend trade, and then the momentum would just keep going and going and going for days on end. Those kind of moves don't really happen anymore, which is why I wouldn't advise going for the 4 and 5 times reward risk as your default. In fact, I would say keep it to about 2 to 3 times. If you happen to develop your own trading to be able to use a smaller stop loss, you may think about increasing that. But there's definitely been a lot of change in the market conditions. So when I first started trading, I could run a $1 trade for 2-3 weeks. Whereas nowadays, first of all, the daily ranges have all dwindled. What happens these days is that There's small daily ranges, so you get maybe about 50 pips in a daily range, and then the market moves away, and then it comes back to the level, then sort of moves away, comes back to the level, and it's all in this really tight range of about 70-80 pips. And then if the market does move, it does so through one candle, maybe over an hour or two, and then it stops, comes back to the level. So it's very frustrating if you're a swing trader looking to get a large risk reward. It just doesn't really happen as much these days. And because of that, I decided to modify this part. So really 4 to 5 times is quite a large risk reward for today's market conditions. As soon as you're around 2.5, just think about booking your trade. Now, when you're looking at your own targets, let's say you have a profit margin of the level only 5 times, which is absolutely fine. It's very likely that there will be another opposing area on the way to your target. So really, you need to ensure that you have enough space from your trade entry to your intended target without running into any opposing supply-demand areas. Okay, and the final filter is the presence of a base or a consolidation. So a level that you're looking at and you want to execute through a limit order has to have a base or a consolidation somewhere. If you're looking at a large time frame, then obviously you will run into normal formations. You may be able to trade it, but then drop down to the daily chart and look for the base inside that whole area to find a nested level. But remember that usually for the limit orders, if you don't have a base, you don't have a trade, because this is a filter. Next up are odds enhancers. Odds enhancers are concerned with primary trend. I take my primary trend through reading of 3 time frames, 4-hour chart, daily, and weekly. And for me, 2 out of 3 of those reference time frames need to match. And not only that, but it needs to be 2 adjacent time frames. So if I only get 4-hour and weekly showing me uptrend, but then daily is a downtrend, to me that's not really enough. To help with the trend reading without going too much into how to read trend through supply and demand, you can get our Blatek supply demand indicator from the MetaQuotes marketplace, and it takes out the pain of you having to learn yet another strategy through supply and demand how to read trend. The second odds enhancer is retracement, which is how many times the zone has been touched. This odds enhancer, it looks at whether the zone has been tested before and also how many times. So ideally you want your supply demand zone to be fresh and untouched. A lot of the times you will see a zone that looks strong, but really it has a first test of the zone really early on, like maybe 2 or 3 candles after the price left the level. If you miss a little pop into the zone early on, it means that the zone is weakened. And finally, the third odds enhancer is how the price arrives at the zone. Now, at the time of you first scoring the zone, this is usually an unknown parameter, because you don't know how the price is going to arrive at the zone, right? But what this does is it looks at whether there's any congestion areas once the price has reached the level. So anything that got created on the way towards the level becomes very relevant. So here's an example of a strong zone that satisfies almost all of the conditions. So the price moves away pretty strongly. By the way, the first move away doesn't have to be done all in one candle. Now, once the price has moved away from the level, the drop actually achieves more than 5-to-1 profit margin. And then if I'm looking at the formation of this area, there is a little doji there. So on lower time frames, there's bound to be some kind of a base that created the doji. This zone was also with the primary large trend taken from 3 time frames, and it was also inside a Q high, inside a high Q point area. Now, I said that this zone almost satisfied all conditions. So what is the problem? The problem is how the price arrived at the level. So if I point to this area, you will see that there's a little demand, like a little speed bump that got created before the price finally reached the area. That means that this small area might put a wrench in the works. It caused the price to go higher. So there was a little bounce from it. You see these wicks, the buying wicks. So not only that there was a little reaction from it, but it took some time for the price to go back the other way. But the whole zone scored high enough to be qualified for a limit order. Now here's one zone that had half of the conditions and therefore wasn't immediately qualified to be a limit order, but instead it was more of a confirmation trade, which means that we will be looking for a specific developing price action after the price arrives at the level. So what do you have? You do have a strong move away, but the profit margin is kind of just barely 3 to 1. There is a presence of a base. It's a very nice base. So when it comes to filter conditions, it's all good. However, odds enhancers. Primary trend, well, at the time of creation, this zone was clearly against the primary trend, so it gets marked down. There is a way to trade against the trend through my established Q points, but again, it's a very advanced way of trading supply and demand. So for the purposes of scoring this supply, because it was against the prevailing trend, it got marked down. Next up is retracements. So the zone was fresh at the time when the price first came back to test it. And then the last odds enhancer is the arrival at the level. Arrival was pretty clean, so there's not much congestion right underneath the area. But the zone scored lower on the profit margin and on primary trend, so it had to be a confirmation entry. So what do I mean by confirmation entry? Well, let me show you what happened when the price arrived at the level. You see the bearish engulfing that happened after the touch? Well, that's your developing price action. So that would justify you going into a trade on the basis of a confirmation. I elaborate this further in the professional development program, but for now that's all you need to know. So you would be using a candlestick pattern at the level to look for a rejection as a confirmation trade. And here is a bit of a unicorn zone that has all the conditions. So initial move was a strong drop-based drop or a staircase supply. Remember I said that on staircase formations, you need to look for that originating area higher up. So this was on a slightly lower time frame, and instead of price reacting from this base, it went all the way up to the originating supply. Profit margin on the level, massive. Presence of a base, well, you have a base drop, so naturally there is a base by default. And primary trend, it was with the primary trend, and it was also inside a Q point. Retracements, so zone was fresh, and then we have the arrival. As you can see, arrival clean as a whistle. Nothing to stop it on the way down. And sure enough, with not much in the way, the price moves all the way down. So if you can see that if the arrival is clean, the price will reach your targets quicker. If you have something on the way, it's not to say that it's not going to work out eventually, but any zone that you come across in the opposing direction adds more time onto your trade, and obviously that's not what you want. Some examples of weak zones, because I don't like to talk about one side of the story. So here's an example where there's a gradual move away. So it's not a strong move away, it's just like price is meandering, there's a lot of choppiness, up and down, and the price eventually just slices through it. Here I have two supplies, both of these are very weak. So the one at the top, it has multiple tests into it. So this is what I was talking about when it comes to retests. The zone gets created, but the very first candle goes back into it. To be fair, it doesn't even leave the level up until this candle. And what do I mean leave the level? It means that no candle is touching the supply area. So if you have this kind of a situation, the top of the candle, the high, is inside the supply. So thereby, that's a retest, and the price has not really left the level yet. It's still messing around in the same area. Now, here's an example of overnight trading in euro-dollar during Asia. Two very weak areas, both a demand and a supply. The main take from this particular chart is that if an instrument doesn't, like euro dollar doesn't normally trade with much volume during the Asian session. So by default, you shouldn't attempt to enter any new positions. Because not only that the profit margin is entirely non-existent in this case, but you'll be working all night to grab 3 ticks there, 5 ticks there, and you constantly have a negative risk reward. So you get hit once and all of that work goes right out the window. So then you've spent an entire 8 hours of Asia trying to trade euro dollar for nothing, probably for a bit of loss, as it usually turns out. But then when London kicks in, and I'm going to show you the next slide. So this is now London. It just obliterates all of the levels. It slices through the demand, slices through the supply, and just shoots up. And that's how new traders get caught out. They're kind of thinking, oh, it's easy. I'll just trade for a few ticks here and there. You know, it doesn't matter. I want to grab 4 ticks in the market, and that'll be enough. But in the spot markets, in cash markets, you have something called the spread as well, unless you trade futures. And the spread is usually anywhere from about 1 to about 4 pips on top of the normal price. So attempting to kind of scalp with a very small retail account and not having a futures account is just completely pointless. Now, I do scalping at Market Stalkers, but I don't take 4 pips out of the market. I take between 20 and 60 pips. And that's the kind of scalping that you want to aim for, not this nonsense of taking 2 and 4 pips. Okay, so exercises for this lesson. You have some homework. Somewhere on this page, either in the exercises section or below the video player somewhere, again, depending on where you're watching this, you will find a downloadable file of the scoring table that will help you determine strengths of zones. And this is what it looks like. So it's fairly simple, just simple table, probability filters, 1, 2, 3, probability enhancers, 1, 2, 3. I will explain what it looks like when the zone scores 2, 1, or 0 for each of these. So for strength of move, these are the kinds of moves away for supplies. So you can have a decent move away, but not terribly strong. However, it then picks up momentum. Or you can have the initial momentum with a less violent follow-through. So both of these examples, they would score a 2. So maximum scores on the strength of move. For the demands, similar, so you can have the initial move that eventually picks up speed, or you can have initial large rally, which is then slightly less violent. So this is what a score of 1 would look like for supplies. So as long as the price kind of keeps advancing in the same direction without too much choppiness, it's kind of going away from the level confidently, but maybe not the most violent move, it's a score of 1. And again, similar for demands, same thing. Price keeps pacing upwards. And now let's take a look at what weak moves look like. So this is a very, very gradual meandering away from the level. Price not really advancing anywhere, but just kind of messing around almost in a range. So that's a score of 0. And similar thing for the demands. Lots of stopping, going back, choppiness, up and down, up and down. So unconvincing moves, even they're not sure which way they're going. Now here is what kind of score you look for with the profit margin. So this one is pretty self-explanatory. I sort of mentioned this already, but let's just have it on a nice visual. So however many pips the zone is comprised of, that becomes your reference for the profit margin. So profit margin that has over 4 times reward risk is a score of 2. If the profit margin on the level is 3 times risk reward but not quite 4, it will score a 1. And finally, a profit margin of less than 3 times scores a 0. Okay, so now I'm going to show you what we're looking for when it comes to arrivals. And this time let's use real charts. So what you can see here, my zone of interest was where this blue rectangle is. So that's my demand that I was looking as a zone of interest. But before the price reached the zone, there are two minor supplies in the way, these red rectangles, and that means the arrival is not clean. You have two supplies in the way. So that gets a score of 0. Every time you have an unclean arrival, whenever the price hits one of these opposing areas, that, even if it works out, it will add time onto your trade. And it might actually mean that the price is not done with going the other way. So obviously it puts your trade in danger. The arrival ideally should be clean. You will have trades that are so much easier if you look for those that only have clean arrivals. But I will be honest, I do sometimes trade these coming from Q points, because I know that when I'm looking for clues of whether there will be a change of trend, one clue is going to be that if you do have an unclean arrival and the price breaks through it, it means that an opposing area has been taken out. Thereby, new direction is probably the right call. But in general, if you're not skilled enough and if you've not lived through those kind of trades enough times, these kind of little speed bump areas are very bad for the life of the trade, so expectancy of the duration of how long you want to stay in a trade. So the more there are of these opposing zones, the longer it will take for your trade to reach the target, because the price has to battle all of this congestion, right? So this is why this is a score of 0 when it comes to arrivals. Remember that I said when you're scoring the zones first, arrival is unknown, because you don't know how the price is going to arrive at the level. But as the price nears your area of interest, your zone of interest, or ZOEs as I like to call them, I like my abbreviations, you should ideally have like an alert just before the zone is reached, so that you can have a look and rescore and maybe add to the score that you've done before to see whether the arrival is clean or not. Okay, finally, for the clean arrival, this is what it would look like. My zone of interest is this blue area. So there was a limit order there waiting, and when the limit order kicked in, I looked to see whether there are any opposing areas. As you can see, the price went straight to the zone in a very clean way. And sure enough, because the arrival was clean, there was very little in the way onto my profit target, and it actually ended up going all the way back to the first supply. And this is why it makes a difference when you have that clean arrival versus unclean arrival. If you've come to a point where you understand how these zones work and you can spot them yourself, it's time to get a tool that alleviates and automates this process. You can get the Blatek supply and demand indicator to automate the tasks that take a long time and become tedious. So it's not there to replace your brain and your trading decisions, it's just there to automate certain mundanity of scoring the zones, seeing whether the arrival is clean or not. So we have code that does all of that for you. And finally, for the homework, now in that same section where you found a download of the scoring table, you will also find some exercise charts with some particular zones marked on them, where the task is to score the zones properly. And of course there's the file with the answers so that you can see how well you've done. And this concludes the Strength of Zones lesson.